Yeah, so good evening. I think I can see Brian again. I can see Irmina. Good evening.
Good evening, sir.
All right. So thank you very much for being available for this class, and let me take this opportunity to officially welcome you to this session for today. Now, at what point did we stop in the last class? Had we done the question? Which had the X NPV and the X internal rate of return? Yes, because I want to think that we stopped at a point where we were to introduce on of course, on that other question, and that's what I want us to do today. Do you guys remember the question we were to proceed to? We were to proceed to December. We were to proceed to a question in December. We were to proceed to a question in December 2022. This is question number 22, yeah? We were to proceed to a question in December 2022. This is question number 22. And so what I'll do is, let me just re-forward the question again so that you guys can remember, yeah? So that you guys can remember which question it is I am talking about, yeah? So check your WhatsApp group. Check your WhatsApp group. You'll find the question there, yeah? So that's the question which I'm talking about. So the first thing that you'll do, yeah, is can you please read through the question, understand it, before we can proceed to solve it, yeah? So read through that. All right, so I hope you have read through the question, and let's proceed to look at what the question require. When you look at what is required, we are told that there are 3 requirements. One, we are told that we have the weighted average cost of capital to be used to evaluate the project. And you realize for that, the question has given 2 marks. And then number 2, we are required to calculate the relevant cash flows over the project period. And then number 3, we should compute the net present value of the project and then advise on the project viability. Let's start with part A, where of course we are computing the WACC, the weighted average cost of capital of the project. So specifically of the project. And so how do we compute this? Let me first of all know whether any of you has an idea, yeah, of how we compute the weighted average cost of capital for a project. Who has an idea? Is any of you having an idea? Anyone having an idea of how we come up with that weighted average cost of capital? Now, what I want you to do, I want you to refer to where has the question talked about the cost of capital. Look at note number 9. And what are we told in note number 9? That Vuma Limited has a real weighted average cost of capital. So that is WACC of 8%. So that is now the cost of capital. Remember, for the entire company, 8%. We are told that, and general inflation is expected to be at 4%. And then the last statement says that due to the risk of the project, Jane feels that the relevant nominal weighted average cost of capital should be increased by 3%. That is the only note in that question, which remember has talked about the cost of capital. And so from that, we need to compute it. Then for this project particularly, the question has given firstly, when you look at note number 9, yeah, the question has first provided what the question has called the real WACC. So in this respect, we shall compute it as what the question calls the real, let me say adjusted for the real, adjusted for what? For the expected changes. The real adjusted for the expected changes. So whenever you want to compute, and I want to believe that this you are taught in your financial management, yeah? That whenever you want to compute for a project, the weighted average cost of capital, take what is considered real, adjust the real by the expected changes. Of course, these expected changes have to be for the project. The expected changes have to be for the project. So in this case, what we shall do, is to start with the real WSEC, which the question is saying is 8%, which the question is saying is 8%. Which adjustments do we expect on this? Then for the project particularly, when you look at note number 9 again, you know, we are told that the first expected change is the change by what is called inflation. And the change by inflation, we are told, is expected to be at how much? Now 4%. What does inflation normally do to prices and costs? What does inflation normally do to prices and costs? Does inflation increase or decrease prices and costs? Somebody. Does inflation normally increase or decrease prices and costs? Somebody?
Okay, I would say that they do increase the prices and costs.
Yeah, so inflation always increase prices and what? Costs. If this 8% is also a cost, then remember it has to be increased then by the expected inflation. To then increase this, we'll say that add. We'll say that add. We'll say that add. We'll say that add. Add, of course, inflation. Add, of course, inflation increase. And the inflation increase, we are told, is expected to be what percent? So you increase or you add by 4. By 4%. You increase or you add by 4%. Look at the last statement as well. We are told that due to the risk of the project, Jen feels that the relevant nominal WSEC should again be increased by 3%. So another increase, we are told that this would be 3%. If that is the case and we have no other change, then of course we can proceed to add them. We proceed to add them. And if we do that, then the answer to the question is this 15. And so that is how you compute it, where of course you have such. Is there any question on this? So simply take what is considered real. We are summarizing that the real adjust for the changes you expect for the project particularly. So in this case, if the real is 8%, and then we are expecting inflation to be at 4%. Remember, inflation normally increases costs. So that means you increase the 8% by 4%. And then we are told we have another increment expected for the project 3%. When you then add all of them, then you end up with a total of how much? Now 15%. If at all there is no question, then we shall proceed on to part B. So that, is there any question on that one before we proceed to part B? Is anybody having any question? All right, let's proceed on to part B. And what does part B require? Part B says that we now compute relevant cash flows over the project period. So we are now determining what we are calling relevant. We are now determining what we are calling relevant cash flows over the project period. So relevant cash flows over the project what? Now period. This is what I want you to remember. The questions are which we have done so far, have summarized for us the cash flows which we needed to compute something like NPV or the internal rate of what? Rate of return. The first two questions which we have done, have summarized cash flows. That is now not the same as the problem which this question present, because this question now present a lot of info, which of course we need to then summarize. We need to then summarize to be in the form in which we had that other info in the first two questions which we have what? Now done. The first thing that of course remember is that how long is the project period? And let me hear from somebody. For how long are we told that the project will last? How long are we told is the project period? Somebody, go back to additional information number 1. When you look at number 1, we are told that Trex is estimated to have a useful life of 5 years commencing which year? 2023. So that if the useful life commences in 2023, it means that the investment we have to do it in which year? The investment we have to do it in the year before 2023, which is the year 2022. And we normally do the investment in which year? In year 0. That means we then have 2023, we then have 2024, we then have 2025. Remember, we are looking for this up to the 5th year. So we have 2026, and of course the last one will be 2027. So 2023 will be period 1, the next one period 2, period 3, period 4, and lastly period 5. And so in terms of our periods, that is the kind of a sequence which we deal with. So I'm just enlarging my columns so that the amounts will fit within them. Now, normally, which cash flow do we have that apply to period 0? Somebody. Which cash flow do we normally have that it apply to period 0? Somebody? Which cash flow do we normally have that is for period 0?
Outlay.
The initial outlay. So we shall first appreciate that for the first year, we start with the initial outlay. Not for the first year, but for period 0, we then start with the initial outlay. And where has the question talked about the initial outlay? I want you guys to look at note number 2. I want you guys to look at note number 2. And what are we told in note number 2? That Trex will require the purchase of a machine, remember at a cost of 100 million shillings. And this would happen at the end of the period year 2022. You know, that's why I said that year 0 for us will then be the year 2020 what? 2022. So the question is very clear that this project will require that you purchase a machine in this year, that's in period 0, remember at the cost, which is 100 million shillings. So we shall say that the initial outlay is therefore 100 million. The initial outlay is therefore 100 million that way. And please remember that the initial outlay must be a negative cash flow. The initial outlay must be a negative cash flow. All right. So the initial outlay we are saying must be a negative cash flow. And so most importantly, remember that the initial outlay should apply to period 0. Let's look at the same note number 1, because I think we have some part of it which we are yet to look at. We are told the machine would be bought at a cost of 100 million shillings at the end of the year 2022, after which the machine will then be sold at the end of the project, which is the 5th year. The price at which you eventually sell the machine you have invested in, what did you use to call this in FM? The price at which you sell the equipment which we are investing in, what did you use to call this price? Somebody, what did you use to call it? Ian and Brian, what did we use to call the price at which you sell the asset eventually? Let me see what somebody has said in the chat. Yeah, so Brian has said that this is what we used to call the scrap value, yeah? So this is what we call the scrap. So the next cash flow will say that we then have the scrap value, the scrap, and scrap is the same as the salvage. This is the same as the salvage. This is the same as the salvage. This is the same as the salvage what? Now value. The salvage value, remember, applied to the last period. The asset is only sold at the project end. In this case, that is year 5, yeah? So that under year 5, we'll have the salvage value. Now, as a cash flow, is the salvage value normally a plus or is it a minus? Is the salvage value a positive cash flow or is it a negative cash flow? Yes? Yeah, so Brian says in the chat that again, that's positive. So please remember that the salvage value is money which we'll receive. And if that is a cash inflow, then of course it should be a positive what? Now cash flow. We'll then say under period 5 that we have 20 million as a plus. As a plus, let's go to note number 3. What are we told in note number 3? That the selling price and cost structures of the product for the first year, 2023, with expected inflation factors are as follows. The first one, we are told we have selling price per unit, material cost also per unit, labor cost also per unit, and then the incremental fixed costs also per what? Per unit. When we have these items per unit, you have to remember that, for example, based on the selling price per unit, what should we determine? When you have selling price per unit, which is the price at which you'll sell the units which you'll produce, you know, if you then take the selling price per unit, you multiply by the number of units that you'll produce and sell, then you end up with what we shall call the sales what? Sales revenue. So one of the important cash flows here will be what we call the sales revenue. And please remember, I have explained that this shall be determined very simply as what? We shall take the units which we plan to sell, we shall multiply that by, of course, selling price, the per unit figure. By, of course, selling price, the per unit figure. So in this case, we know, for example, selling price for the first year, which is 2023. That is what, when you look at note number 3, we are told that the selling price per unit for the first year, we have that 5,000 shillings. To then get the total sales revenue for this product, will take that selling price, will multiply by number of what? Of units. The same will, of course, apply to the costs. We will need, for example, the total material cost. The total material cost, which again will be number of units multiplied by material cost per unit. Per unit. And so the same will apply. The same will apply to direct labor, to direct labor, to direct labor cost, and the same will also apply to what we are told is called the incremental. To what we are told is called the incremental fixed cost. All right. So if that is the case, then the concern which we have, yeah, the concern which we have is where do we find the information for the units? Where do we find the information for the units? In which not number? That was not number what? Where is the information for the units? Let's look at note number 8. And what are we told in note number 8? That experience has shown that the demand for a new product is not exactly known in year 1, but then tends to be stable thereafter. Now, Jane has come up with the following estimates of demand, we are told, for the year 2023. The year 2023, remember, is the first year. That's year 1. So the demand for the first year can only be estimated, remember. And of course, that is what is true for a new product. They then estimated the demands and their probabilities. Like at the first probability of 30%, they expect the sales demand to be 40,000 units. At the next probability of 40%, they expect demand to be 30,000 units. And then at the last probability of 30%, they then expect a demand of 10,000 units. Now, somebody, based on that, how do we get the sales units for the first year? Because remember, we must compute just one quantity as the sales units. Excuse me. We must compute just one quantity as the sales units. Then for that that first year, how do we compute one sales demand for that first year? What do we do? Somebody? Yeah, so Brian says that we look for the summation of probability times the expected what? Expected sales. So that is right, Brian. So what we'll do is to say somewhere down here that we have workings, and I will start with working number 1. As working number 1, we shall compute units of sales. We shall compute units of what? Sales. Like Brian rightly says, we are going to take like the first demand, which is 30%. We multiply by how many units at that demand? 40,000 units. Again, we'll take the next demand. We'll take the next probability, 40%. Multiply by the units at that probability, we have 30,000. And then the last 30%, the units at that probability, we have 10,000. And so what Brian has said, which is correct, you take the probability, multiply by the associated demand. Like now the first one gives us 12,000. You'll do that for the rest. you'll do that for the rest. And so at the end of the day, what you'll do is to sum them. And if you sum them, we have a total of that much. If you sum them, we have a total of that much. If that is the case, then those are the units which apply for which year. Those probabilistic demands, remember, applied for year one. Applied for year one. I'll come back here and say, I want all my workings to be under the respective years. And so I'll say that then under year one, you know, is this column for 2023. Under that column, then I'll say that I have this 27,000. So the units which then apply for year one, we have those 27,000 what? Now units. The question that then arises is, yeah, what about now for year 2, year 3, year 4, and then year 5? You know, we need the demands for each of the 5 years. So far, we only have for year 1. How do we get it for year 2 to 5 also? Yeah, so how do we compute the demands for year 2 to year number 5? What I want you to do is to look at note number 8, the last part of it. Note number 8, the last part of it. What are we told there? We are told we are told that Jane expects an initial increase in demand. Yeah, note number 8, the last part of it. Jane expects an initial increase in demand in year 2024 of 25%. Remember, year 2024 is the second year. So the expectation is that demand will increase then by 25%. So when you come to year 2, we shall take this demand for year one, we shall increase it by 25%, yeah? To then increase by 25% means that we multiply by what percent? Somebody. To increase by 25% means that we multiply by what percent?
Okay, I suppose that we will multiply by 100.
By 125%,
or 1.25.
Yeah, so you multiply by 1.25, or just make it simple, 125%, yeah? So multiply by 125%, that means in year two, we then have 33 what? 750. So that's the first increment which we expect for year one, or rather for year two. What happens in year three? Go back to the same info. After the 25%, what are we told? That then a decline of 50% in year 2025. Year 2025 is this year three. So when you come to year three, we now take this demand for year two. We want to decrease it by 50%. So somebody, to decrease by 50% will mean that we now multiply by what percent? Yes, to decrease by 50% will mean we now multiply by what percent?
I suppose we'll multiply by 50%.
Yes, by 50%, that's correct. And so what you get is that 16,875. What you get is that 16,875. Look at what we are told happens after 2025. We are told that this level will remain the same until the end of the project. That means that year four will have the same demand of 16,875, and so the same will apply to year five. And so the same will apply then to year five. And that means that we are then done with the calculation of quantities to work with the calculation of quantities to work with, so that next, what have we? You know, next will be to calculate what? If you come back to this working for the relevant costs, something like the sales revenue, I have said you need to take units. The units are what we have here. Multiply by selling price per what? Per unit. The prices per unit we were given in the costs and prices per unit. You get that in note number 3. But what the question has given in note number 3, remember, are the price and cost structures for the first year. The first year is which year? 2023. Let me say here that as working number 2, I want to acknowledge the selling price per unit, so that for the first year, we are told this should be how much money? This should be 5,000 shillings. So that should be 5,000 what? Shillings. The question is, what about now year 2 to 5? How do we know the selling prices per year from year 2 to 5? When you look at note number 3, besides the per unit figures, we are told we have the inflation rate percentage from 2024. 2024 is the second year. From 2024 onwards. what did we say that the inflation does to prices and costs? What does inflation do to prices and costs? Yes? What does inflation do to prices and costs? What did we say?
It increases prices and costs.
Yeah, so it increases prices and what? Costs. So if we are, for example, told that the selling price per unit in year one is 5,000 shillings, and then in the years which follow, we expect inflation of whatever percentage, then we shall keep increasing the price by that percentage per year, because the percentages we are told are from year two onwards. So what we'll first do, let's have all of them so that number 3, we'll say that we have the material cost per unit also. And then number 4, we have direct labor cost per unit also. And then number 5, we have what we call the incremental fixed cost. You know, we have all of them for year one. And so like now for the material cost, we are told that this is 2,000 shillings. The labor cost for year one, we are told we have 1,000 shillings. And then lastly, the incremental fixed cost, we are told that we have 500 what? Shillings. Now, what increments do we need to have on them? Let's start with selling price. The selling price for year one is this 5,000 shillings. Remember, we need to increase it by the expected inflation. And how much inflation do we expect on selling price? So that times, we expect an inflation rate of 2%. That means we increase the price for year one by 2%. So that means we multiply by 1 or 2%. The same thing will apply to the material cost. I take that for year one. I multiply. Be careful about the inflations because they are not similar for the 4. Like for material cost, we are told we now have 4%. So times 1 of 4%. And then, of course, for direct labor cost, I take what I have for year one. I now multiply by how much? By the inflation will be 5%, so 1 of 5%. And then lastly, for the incremental fixed cost, the 500 for year one, times in this case, I expect inflation to be 10%. So times 110, times 110%. So that, is that okay, gentlemen? Is that okay? Are we together to that point?
Yes, we are together.
Yeah, if we are together, then you know when you come to year 3, year 4, year 5, you will very simply keep increasing by those percentages. When you come to year 3, year 4, year 5, yeah, you will keep increasing by those percentages. Now you don't need to keep doing that manually. You can highlight all this. You can highlight all this, and then